Hello and welcome. You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with headlines. Gold becomes dearer. Gold prices cross 64,000 per 10 gram on MCX as on the back of weakening in the rupee and surge in demand. An unemployment rate comes in at 9.16% in November from a 29-month high of 10.05% in October. Urban unemployment remains a cause of concern at 9.39%. Crisis at BYJU'S fails to pay employees' salary for November. Byju Raveendran pledges family homes to raise funds for salaries of 15,000 employees. And IT sector growth to inch up to 6% in financial year 25, says rating agencies ICRA, hiring to remain moderate for the next 3 quarters. And Indian banks wrote off 10.6 lakh crore rupees in the last 5 years, 50% linked to large corporates and services sector. All those stories right here on Newsline. I'm Shweta Kothari, with me is Karthik Malhotra. Karthik, hi, good morning.
Morning, Shweta.
The top story that we are tracking here is the gold prices. Gold, the precious metal, the yellow metal, appears to have become more dearer. It has inched to 64,000 per 10 gram mark. Came down slightly last evening, but the demand is unabated.
What do you do with 4 lakh weddings happening, Shweta, in
You buy
one
gold.
city, Delhi NCR? 4 lakh weddings in this wedding season, a short one, about a month or so. Obviously, Indians love their yellow metal and are going ahead and buying gold like nobody's business. But that is as far as the India story is concerned. Obviously, there is a large demand for gold, and this demand starts right from the season of Dhanteras going up all the way to Diwali and now the wedding season. So this entire last 2 months and continuing for another 1 month from now is when we will see domestic demand for gold continuing to soar, and that is going to keep prices of gold obviously on a boil. Now, what is happening internationally is a slightly different story. Now, the Fed commentary which came in suggested that there could be rate cuts in the interest rate cycle, which has been at an elevated level for about 20 odd months now. There could finally be some signaling of a rate cut in the US. Now, what is that going to do? When the rates were hiked, you saw money flowing out of US stock markets and going into the treasury bonds. And then we saw treasury yield, breaching the 5% mark. Now, if there is going to be a rate cut, people don't see too much value in investing in treasury bonds. And gold continues to be a safe haven. So money is getting pulled out of the US treasury and going back into the yellow metal. But the dichotomy that comes to mind right now, especially in the Indian context, is that the old adage says that when stock prices are high and when stock markets are on a bull run, gold is usually down.
That is not
and the
happening.
reverse is when gold prices are high, the stock markets come down. So only when markets are not giving you enough return do people pull out money from the markets and invest in gold. And when markets start giving better returns, people sell their gold and invest the money in stock markets. But what we are seeing right now is a sort of coupled momentum both on stock markets and gold prices. They are both touching all-time highs. So gold at 64,000 rupees per 10 gram at an all-time high. Sensex at 69,000 plus points this morning at an all-time high. So that dichotomy is difficult to sort of comprehend right now.
All right, and look at that chart of gold prices. Gold that was at, it's been evenly going up since 2019, come to think of it. June is when we saw a slight dip, June of 2022.
That's right. That's
and
right.
from 2023 onward, the trajectory has remained.
So again, if you
on
look
a
at
high.
2020, maybe around March, which is when the stock markets had crashed, you saw gold had inched up to its then lifetime high of about $1,650, $1,700 per ounce level. When the market started picking up again in July, August onwards, you saw gold going down. And that trajectory is easy to map all through until perhaps, the last 1 month or so that we are seeing gold is inching up, and so are the markets. Now, this in turn, because India is a gold importing nation, there is obviously pressure on the Indian rupee. And we've seen that while stock markets are at all-time highs, gold prices are at all-time high, rupee is at an all-time low. So there is more selling off the rupee or using the rupee to buy gold in international markets, and that is adding pressure on the rupee vis-a-vis the dollar, and the dollar continues to strengthen while the rupee is weakening on account of this demand of gold.
All right, so all those who are looking at gold prices today, knowing that they are in a very high range territory, should they be buying or not buying? What are the experts and analysts out there saying?
Right. So, Shweta, I mean, you and I are not the best experts to give financial advice to anybody, but what analyst views are also mixed. There are many analysts who are expecting this surge, this rally in gold prices to continue. And this is going to further get augmented if we have a clearer sort of deadline of the US cutting rates. Until then, in anticipation, people will continue to pull out money from US Treasury and continue to invest that in gold. So in the short run, another few days of lifetime highs of gold may not be ruled out, right?
Okay.
But at 64,000 odd levels for 10 grams in India, gold is already very expensive. So those who are looking at investing in gold for returns, some sort of assured returns over a 6-month, 1-year, 2-year horizon, may want to actually go back to a financial advisor and check how much of their portfolio, how much of their asset allocation right now should include gold. Because there are other analysts who also fear that once this wedding season is over and once this abnormally high demand for gold tapers out, you may not have gold cross the already very high levels.
Right.
So from an investment perspective, again, because India being a gold importing nation, there is an import duty that we pay on gold when you're buying physical gold. In addition to that, there are making charges. On those making charges, there is GST. So when you want to invest in gold, jewelry, and that is something I think most financial advisors, most analysts happen to be in sync with that view, that if you want to look at gold as an investment route, then jewelry is not the product
best way of
and
investing.
the best.
So that begs the
vehicle.
question, what is the best way of investing in gold?
So I think gold ETFs, if you want to regularly trade gold and try to make some money off trading gold regularly, gold ETF is something most financial advisors are big proponents of. And in addition to that, there are the sovereign gold bonds, which in addition to the appreciation of gold year on year, also offers a 2.5% interest rate over and above the appreciation. And add to that, if you were to hold the SGBs for the whole duration of 8 years, then the returns that you get by selling off those gold bonds are also tax-free. So overall, no tax, no short-term gain, no long-term capital gain, no addition to income tax if you hold the SGB for 8 years. So a tax-free sort of, you get all your money, the appreciated money, and you don't pay taxes on it. And then a year-on-year 2.5% interest rate. So SGBs continue to be one of the favorites of gold investors.
And let's also take that question to Kunal Shah, Head Commodities Research, Nirmal Bang, joining us on the show. Kunal, thank you very much for taking time out. Good to have you on the show. In line with what we were discussing, is this the right time to buy gold? And if not, should one wait for the prices to go down? Is that likely to happen?
I don't think so. There's going to be a major downfall in gold prices. The outlook on gold for the 2024 and even for the next 2-3 years continues to remain bright. The matter of fact is that the kind of problems global economy is facing on the geopolitical front, with every passing day, the geopolitical scenario is continuously worsening. Second, on the monetary policy front, we are not going to see any aggressive rate hikes from here. So over a period of like 6 to 8 months, the likelihood of the US interest rates or the interest rate in other developed part of the world is likely to edge lower rather than inch up from here. And the third most important reason, central de-dollarization process is actually picking up at a rapid pace. So the volatility is going to be there. There is going to be a bouts of correction, bouts of upside, but the eventual trend in gold continues to look very strong. And I recommend you can buy at these levels, 62,000 around, you can go long in gold. Next year, the likelihood of gold testing $2,400 on COMEX and 68 to 69,000 rupees on India is very high.
Okay, Kunal, I wanted to understand the sort of dichotomy which is playing out, in commodity prices vis-a-vis gold in particular, vis-a-vis the stock markets. Usually there is suggested that there's an inverse relationship between stock markets and gold prices. But for once, we are seeing that they are both at all-time highs and the rate of growth in both is almost similar. You have Sensex breaching the 69,000 level today, and you have gold at about 64,000 rupees per 10 grams. That inverse relationship seems to be history right now.
I think this is a very good question, and the answer to that is the world has changed post 2008 crisis, and world is even drastically changed from 2021 COVID crisis. So the kind of liquidity infusion which has taken place in the global economy, I mean, can you imagine the kind of $5 trillion were printed in a matter of 1 year and was given in the markets, and this money is causing all these sort of irrational exuberances. So right now, with the higher interest rate, gold is rallying. With the higher interest rate, stock markets are rallying. With the higher interest rate, bitcoins are rallying. So this is not making the traditional economic theories are big question marks. So if you are a graduate from one of the top B schools in the world, and what have been taught to you, the markets are not behaving. Whatever central banks did in 2020, 21, in 2008, post that, the entire equations, the traditional economic theories are at toss right now. So it's absolutely right. It's because of the central banks printing irresponsibly at the time of COVID. This kind of irrational exuberance is taking place in the market, and this is not going to go away. We are not going to see central banks deleveraging their balance sheet to the levels what they have done post COVID crisis. So balance sheets are not going to deleverage, and hence this kind of anomalies will continue to remain in the market.
Okay, and Kunal, talk to us also about the kind of pressure that the Indian national rupee is going to face vis-a-vis high gold prices. So we already have the rupee at an all-time low. And if, in your assessment, gold could breach the $2,500 per ounce mark, then that is bound to have added pressure on the Indian rupee.
Well, I think Indian rupee, the fiscal scenario, one of the reason why rupee is weakening is, one of the reason is gold. It's not just attributed to gold. India is growing at a rapid pace right now. We are adding $350 billion of GDP every year with the kind of growth. So the imports are growing up. The import bill of our country is growing up. Exports are picking up, but not at the same pace right now. So yes, we do have a pressure on our rupee, but I believe going forward in year 2024, the depreciations sounds quite limited. I am not expecting Indian rupee, USD INR pair to go about 84, 84.50, but gradually rupee will appreciate. So it's a slightly contra call from my end, because I'm expecting dollar index to significantly weaken in 2024. So rupee should gradually strengthen, USD INR pair, and it should test 82, 81, 80 and a half. That's our forecast.
Okay. And for somebody who is literally looking at gold right now, not to buy jewelry in the ongoing wedding season, but purely as an investment tool, should there be a change in the asset allocation percentage for gold? And if so, then what should be the best instrument in this market scenario to go ahead and invest in gold?
Okay, I'll just answer your question by indicating what China is doing. So after the irresponsible printing, China has been aggressively buying gold. Every month they are buying 25 to 30 tons of gold, and they are the world's largest producer of gold. So it's all about having a goal. It's a strategic investment right now. So say 3 years down the line, if there is a global central banks meet and they say that how to solve this problem, the only way, it's like working something out. You cannot just print currency like anything. It has to be backed by something. And if this kind of standard, gold standard again reappears, then I think gold is going to go to roof. So only thing which is truth right now is gold. Rest, all the liquidity related inflated asset bubbles are going on. Gold is actually fundamentally one of the strongest asset class right now. Even at this level, I recommend that you should have it in your portfolio. Even if I go wrong, if my view go wrong, I'm pretty sure the downside is very limited. So it's a strategic investment and it's must in your portfolio right now. And 15%, 18% of your portfolio should be in gold.
All right, 15 to 18% of the portfolio should be gold. That's the word coming in from Kunal. Kunal, thank you very much for taking time out. Thank you for joining us here on the show. And shifting focus to a story that is coming by the way of India's unemployment rate, which has come down to 9.16% in the month of November, albeit a little lower than the October high of 10.05%. It is still very high. And what's causing more worries is the urban unemployment, which is now upwards of 9.35%. What's happening here?
Shweta, I think unfortunately, the headlines are suggesting that India's unemployment rates have improved, but then they've improved only on a month-on-month basis from a 29-month high of October. It is still a very, very worrying sign.
Absolutely.
At upwards of 9% unemployment rate, you're looking at almost the same double digits that you had seen last month, of course. But prior to that, in the peak of the COVID era in 2021, that is when you had actually seen unemployment rate breach the double-digit mark. Now, this obviously now comes at the back, this softening, so to speak, comes on the back of improvement in rural unemployment, but that improvement is only about a quarter of a percentage point.
And also on the back of a sowing season.
And exactly, right. So that a very, very meager quarter of a percentage point on the back of the November sowing season, and November in any case historically since 2019 has been among the best months when it comes to unemployment. So lowest levels of unemployment in rural area happen in November because of the sowing season. So the Kharif crop is getting harvested and the Rabi sowing continues in the month of November, and that obviously gets more people who are associated with the farm sector in the agriculture industry employed in rural areas. But the worrying sign is that there is almost a percentage point decline on the negative side for urban unemployment. Now, this is coming again on the back of mass layoffs that we've seen from startups to IT sector and in general corporate India not really, faring as well, barring a few sectors like FMCG and banking. The results have been fairly muted. Now, this is something which obviously when you talk about a Q1 growth rate, GDP growth rate of 7.8%, a Q2 GDP growth rate of 7.6%, revised estimates making the rounds that India's economy could grow perhaps in the range of 6.7 to 6.8% this year. This growth to be sustained with high levels of unemployment just suggests one thing, that there is going to be this disproportionate growth in the wealth of Indians. The rich are likely to get even richer, and those are the ones who are paying higher taxes, and those are the ones who continue to either be employed or are employment generators, entrepreneurs.
I want to highlight this interesting dichotomy. So on one hand, we are looking at a growth that has exceeded expectations for everybody at 7.6%. On the other hand, we're also looking at joblessness, which is at an all-time high. How do we really explain this dichotomy?
Which is what is the worrying dichotomy, Shweta, that growth on the back of government spending, growth on the back of high consumption in a high inflation scenario.
Who's spending
by those who have the money, right?
Exactly.
By those who have the money. So there is consumption adding about almost 60%, 58% to India's GDP, and the balance in good measure coming from government spending, especially on infrastructure, are what are aiding economic growth. But this growth is definitely not equitable. This growth is depriving almost 10% of the population of the country from finding something as basic as a job which can help them fend for themselves and their families. So jobless growth, I think, is a big sign of worry for India. And instead of running after headline figures of GDP growth, India has to look at employment generation very seriously right now. Now, how does India do that? Number one, you have got to have the right policies in place and perhaps tweaking of policies to enable corporate India to give more jobs. There has to be more rural entrepreneurship as well as urban entrepreneurship of sustainable businesses rather than fly-by-night operators or companies which command high valuations only to realize that business is not sustainable a year, 2 years, 3 years, 5 years down the line and letting go of people who are getting hired. But overall, at almost a double digit, even though it is a softening from last month's data, we are still looking at upwards of 9% of unemployment rate. Remember, the problem that China is facing right now is that 20% of its youth, double that of India in percentage terms, but 20% of its youth is unemployed. That has obviously had a major impact on property purchases, on automobile purchases, on high value goods purchases. So any sort of discretionary spend which is expected from a population as large as China's is now getting compromised to a tune of about 20% because of that high unemployment rate. Now, how long can India actually afford to get the government to keep investing and some sections of society who are employed and who are perhaps, the richer of the lot to continue drawing the consumption story forward? I think at some point there has to be a very, very serious sort of policy intervention to ensure that this number comes down to no more than about 4%, 5% or so.
Right, and policy intervention not just by the way of providing, employment or unemployment wages through Manrega, but actual job creation.
Job creation
is what is required.
True.
And also for private companies to pump in more money to start employing more people. I think that is what we are looking at to sustain this growth momentum, because it cannot sustain
we keep
without
talking
jobs.
about animal spirits of corporate India yet to be unleashed. There are contradictory reports which say that no, corporate spending, capital formation has increased quarter on quarter, year on year. But I think the point is very simple. Right now, what is the first challenge that India has up, against right now? It is not being the best scoring country in the world on GDP growth rate. That is in any case happening by default. You are growing much faster than the rest of the world and you have done something right. But I think this big elephant in the room of employment has to be addressed, and if that requires perhaps in the upcoming budget a little bit of relief to corporate India by way of taxes. There is this debate that corporate taxes are already lower than income tax rates. So how should, why should corporate India be given a SOP in addition to what the employees that corporate India hires pay as taxes? But I think if that has to be reduced from 25% down to about 20% or so to spur growth, to keep their profitability higher and enable them to get more people on board, I think that is something that India should consider right now. Secondly, the PLI story, the manufacturing story in India, while it has kicked off in smartphones and certain sectors of the economy, it hasn't really been effervescent. We haven't seen it across the board where there are more manufacturing units coming up, employing people in hundreds, if not thousands. So that is something that India has to very, very clearly incentivize, if not through PLI, if not through a tax holiday, then at least through making land and labor reforms come through quickly, that companies are able to set up big plants and unleash the animal spirits that have been elusive to go ahead and employ more and more people. And I think this whole pivot from gig economy workers who are still part of the unorganized sector, so to speak, not specifically on payrolls of companies, but largely just contributing on a daily wage basis, some sort of a formalization, some sort of a structuring of employment, formal employment for the gig economy also has to be taken into account.
Absolutely. The jobless growth that we're looking at right now, not sustainable in the long run. Government, therefore, has an opportunity here to spur growth by the way of employment and employing more people. That should be one of the policy agendas for the years to come. But talking about unemployment and also perhaps how a big companies fail to hold up to its growth promises and its momentum, Byju Raveendran is a man who flew too close to the sun and perhaps burned himself in the process. He has not been able to pay up salaries of over 15,000 employees for the month of November. Just yesterday, there were reports that there is a technical glitch. It appears that that technical glitch is actually absence of enough money.
Absolutely, and which is what we stuck our neck out yesterday and said, Shweta, that I think there is no fundamental technology-related technical glitch, but there is a glitch in the P&L of the company and there is a glitch in the cash flow of the company, and that is fairly apparent now when reports are suggesting that Byju Raveendran is putting up his own two flats as well as one under construction villa in Bangalore to raise money, and that money and these 3 houses being served as collateral for Byju Raveendran to raise money and pay salaries of those 15,000 odd employees for the month of November. Now, 15,000 is almost 50% of Byju's current workforce. If you remember, after rounds and rounds of firing, there was some estimation that we had made that Byju's present headcount would be in the range of about 32 to 35,000 people. Now, 15,000 means almost 40 to 50% of them have not been paid their dues for the month of November. So, Byju Raveendran there trying to raise up to $12 million on his own volition by putting his own personal assets up as collateral to get that money to pay salaries. Now, all this is also coming at a time when, apart from all the other issues that Byju Raveendran and the BYJU'S company Think and Learn has been facing for the last 1.5 years or so by way of valuation cuts and outstanding loans, etc., is that now the BCCI, the Board of Cricket Council of India, is looking at filing insolvency, or has in fact already filed an insolvency plea at the NCLT in Bangalore against BYJU'S, because BYJU'S has not lived up to its 2019 contract and had to pay BCCI 158 crore rupees, which it hasn't been able to pay yet. So obviously BCCI also, as sort of, as a party involved in this whole BYJU'S mess, or one of the collateral damages of the mess in BYJU'S, has now knocked on the doors of NCLT, filing an insolvency petition against BYJU'S, maybe forcing it, pushing it into insolvency. Now that hearing is slated on December 22nd, and hopefully before that there should be some reply from BYJU'S, and we will know on 22nd December if NCLT rules in favor of BYJU'S insolvency or not. But troubles at BYJU'S are not ending by any stretch of imagination.
Would it therefore be right to say at this point that it looks like end of road for BYJU'S? A company once valued at $22 billion and upwards is not able to pay money to its 15,000 employees. It has come to a point where Byju Raveendran had to pledge his own private property to pay up employees. So what's the road ahead looking like for BYJU'S?
Shweta, we saw the FY22 audited results which came out in the first week of November, suggesting that while revenue grew about 2.3x, the losses actually narrowed, but losses were still in a couple of hundreds of thousands of of $1 million worth. So you know for a fact that there is a continued cash flow issue with BYJU'S. FY22, to my mind, was still a better should have been a better year for BYJU'S as compared to the next year, which is FY23, and this ongoing FY24, and we are yet to see the books of FY23 to understand, is there any cash in the system? Was there any cash expected which never came in? And what have been the kind of expenses that BYJU'S has made in FY23? And then the first half of FY24 also over. Obviously, the company does not have enough money to pay salaries, something as basic as salaries for employees. So, this coming on the back of education returning to normalcy, and in any case, a beleaguered edtech player not finding enough, moral standing and enough financial standing in the edtech space right now. So, obviously, cash flow is a challenge for Byju Raveendran. The sooner he admits it, the sooner the board at BYJU'S admits this problem and either draws out a roadmap for recovery of the edtech player, or goes ahead and files for insolvency, is something that the board has to decide upon. But something has to be done, and done really quick.
Absolutely. Something needs to be done really quick. Not a very good news coming in from BYJU'S, and this is adding to the plethora of bad news at BYJU'S, the latest of which is Byju Raveendran had to pledge his own home to pay the 15,000 employees whose dues are awaited for the month of November. But moving ahead to IT sector in India, which has not had a very good year, it could inch up to a 6% growth in financial year 25 as opposed to 4 to 5% which was estimated, but hiring will remain moderate. All this information coming by the way of a rating agency ICRA. What is interesting to point out here is that every day that we discuss IT sector, IT stocks they do not seem to be reflecting the same sentiment as many analysts are hoping and predicting for IT sector in India to have, which is a perhaps washout year, a moderate year, and hiring is also reflective of that sentiment. Amid all of this, good news coming in.
I wouldn't really call it good news, Shweta. I would say it is better news than this year. So this estimation of growth coming in at 6% is for FY25,
yes,
which starts 1st April 2024 until 31st March 2025. So it is better news compared to the current financial year, where the IT sector has had a very, very tepid sort of growth at, and the expectation for it to close the year between 3 to 5% each. So a figure of 6% growth in FY25, looking a little prettier than a higher estimate of 5% for this year. Having said that, compared to, let's say, last year, the IT sector grew in FY23 at about 9.2%. So 2 years later, FY25 growth coming in at a 50% decline from 9.2% to about 6% is definitely not as rosy a picture as anybody in the IT sector would want it to be, or investors in IT stocks would want it to be. However, again, having said that, the estimate or the forecast or prediction of a washout year, FY 2025 being a washout year for IT, has also been laid to some rest by ICRA. Now, again, all rating agencies, all analysts have certain, forecasting mechanisms through which there are certain events that are put into the equation, and there are certain events which are still unknowns. So, will this happen for sure? Will IT grow for sure at thereabouts of 6%? Nobody knows, neither does ICRA. But I think a lot of this finding is coming on the back of, again, the Fed announcing in the US that it could look at a rate cut cycle beginning as early as Jan. Remember, their financial year is the calendar year, which is Jan to December. So early next year could mean perhaps as early as Jan or Feb or March. And if that were to happen, then you're obviously looking at the US stocks market doing better, and the money coming back, the sort of, cost of raising capital for corporations in the US easing, and with that cost easing, some sort of discretionary spending should take off. And if that takes off, it is obviously good news for India's IT sector. So I think ICRA definitely looking at the Fed commentary, and in addition to that, also hoping that whatever cost pressures that we are seeing on account of oil, on account of rising gold prices, should hopefully begin to ease as the rate cut cycle in the US kicks in. And with that, the sort of discretionary spending for India's IT sector, towards India's IT sector, should take off. But still, the next 2 to 3 quarters,
there's no hiring.
There's unlikely to be any hiring, because even if Fed cuts its rates in Jan or Feb, by the time that rate change trickles down to borrowing for corporate America and then restarting or initiating new contracts for India's IT sector, you could easily look at a 6 to 9 month window. But then that again comes in FY25. So maybe a muted H1 for FY25 for the IT sector, and thereafter we should see some sort of a hiring uptick.
Right, a better next half of FY25 for the IT sector. Well, that is the prediction so far. So that is as far as IT sector is concerned. But moving on to a story that is coming in by the way of India's banking, and the banking space in fact wrote off about 10.6 lakh crore in the last 5 years. Now in financial year 23, a total of 2.09 lakh crore worth of loans were written off by banks, out of which 52.3% were linked to large industries and services sector. This as per Minister of State for Finance Bhagwat Karad in a response to a question in Lok Sabha. The government on Monday informed Lok Sabha that all scheduled commercial banks have written off nearly 10.6 lakh crores in the past 5 years. The share of large industries and services was highest at 62.3% out of the total written off loans. It also said that nearly 2,300 borrowers, each having a loan amount of 5 crore rupees or more, willfully defaulted around 2 lakh crores in the past 5 years. All that information coming in by the way of government's written response in the Lok Sabha. That is, of course, as far as the banks and their write-off in the last 5 years is concerned. But with that, it's a wrap on this bulletin. Thank you very much for watching.